Okay, let's jump right into this explainer. I'll be your friendly educator today as we explore this fascinating and rapidly evolving world of cryptocurrency. Now, if you've been anywhere near the internet or watched the news over the last few years, you've definitely seen the endless headlines. It has generated a massive amount of buzz, for its skyrocketing gains and its dramatic crashes. But just because everyone is talking about it doesn't mean it's actually well understood. In fact, for most folks, it's still incredibly confusing. So today, we're going to strip away all that complex jargon and break this down into clear, everyday concepts. Here is our roadmap for today. We'll cover 1. What is cryptocurrency? 2. The engine, blockchain. 3. Wallets and digital keys. 4. Bitcoin versus stablecoins. 5. Investing and tax realities. And 6. The risks you absolutely must know. Section 1. What is cryptocurrency? The digital money revolution. Let's start right at the foundation. So, what actually is cryptocurrency? Well, if you've ever felt a little intimidated or lost when people start throwing around terms like decentralized finance, believe me, you are definitely not alone. It's completely normal to feel overwhelmed, but behind all the hype, the core idea is actually pretty straightforward. At its core, cryptocurrency is just a form of decentralized digital money. It's not issued, it's not controlled, and it's not backed by any central authority like a government or a bank. Unlike the dollars in your pocket that are managed by the Federal Reserve, this money operates entirely on its own independent network. It's totally digital, and the absolute key word to remember here is decentralized. You don't need a traditional financial institution to send it. It's a completely peer-to-peer system. Section 2. The engine, blockchain technology, the magic behind the system. Let's look at how this actually works. Think of traditional centralized banking like a locked bank vault. The bank controls the money, they keep a private ledger of exactly who owns what, and you basically just have to trust them to get it right. Now contrast that with a decentralized blockchain. Think of the blockchain not as a locked vault, but as a friendly, shared digital record. It's a ledger, sure, but it's spread across a vast network of computers all around the world, where everyone helps verify it together. Because no single institution controls it, it offers an incredible level of transparency. So how does a transaction actually go through without a bank? First, a transaction is initiated. Then, the network community works together to verify it. These verifiers, usually called miners or validators, use specialized computers to solve complex mathematical puzzles. By doing this, they prove the payment is legit and that you actually have the funds. Once the network agrees, the transaction is permanently added to the shared ledger. And once it's locked in there, it becomes extremely difficult to ever change or tamper with. That permanence is exactly what makes the system so secure. Section 3. Wallets and digital keys. Holding your assets safely. Let's clear up a major misconception here. Despite those shiny gold Bitcoin graphics you constantly see on the evening news, there are absolutely no physical coins. You literally cannot hold them like cash. You can't put a Bitcoin in your pocket or a piggy bank. Everything exists purely digitally. To interact with this digital money, you use a wallet. This could be an app on your phone, software on your laptop, or even a small hardware device that kind of looks like a USB thumb drive. But here is the crucial point. Wallets do not hold coins. They only hold your private digital keys. Your wallet is basically a super secure keychain holding the encrypted codes that prove to the blockchain you own your funds. Without those keys, you simply cannot access your money. Section 4. Bitcoin versus stablecoins. Comparing the digital assets. Not all crypto is built the same. 21 million. That's a big number, but it actually represents the absolute maximum fixed supply of Bitcoin that will ever exist. Because its software dictates a hard cap, a lot of folks treat it as a highly scarce, deflationary asset. Once they're all mined, that's it. Because of that built-in scarcity, Bitcoin is incredibly volatile, but it's historically viewed by many investors as digital gold and a long-term store value. Stablecoins, on the other hand, are completely different. They are pegged to fiat currencies, like the US dollar, to intentionally avoid that crazy volatility. They're designed to act as a stable medium of exchange, so you can easily trade or send money without worrying about wild double-digit price swings in a single day. Section 5. Investing and tax realities. Bringing it back to your portfolio, let's make this highly practical. So how are people actually using this? Well, investors often use cryptocurrency to diversify their long-term portfolios, right alongside their traditional stocks and bonds. Because of its historical performance, many long-term investors are carefully adopting it as an alternative asset class to kind of balance out their traditional investments. But you have got to be super careful here with the tax realities.
Tax reporting is absolutely required when you sell crypto for a profit. But here's what catches a lot of beginners off guard. Exchanging crypto to receive a good or service is also a taxable event. If you buy a cup of coffee using Bitcoin that went up in value since you bought it, you just realized a taxable gain that has to be reported to the IRS. So using standard crypto for everyday purchases can get really cumbersome. Section 6, the risks you must know, protecting yourself in a new frontier. As an educator, this is probably the most important thing I'll tell you today. There is zero FDIC or SIPC insurance in crypto. None. It is not insured like the cash sitting in your traditional bank account. If a regular bank fails, the government steps in to protect your deposits. But if a crypto exchange goes bankrupt or fails, you do not have those traditional government protections to bail you out. Your money could just be gone. The reality is this digital frontier is still very much the Wild West. Exchange platforms can be hacked or simply stop operating without warning. Even your own digital wallets are vulnerable to hacking if you aren't vigilant. And remember those private keys? If you lose them, there is no customer service desk to call. Your money is literally lost forever on the blockchain. Because of these core vulnerabilities and the extreme price volatility, you should only ever invest an amount that you are entirely comfortable losing. Crypto is undeniably a massive part of the global financial conversation now. It's challenging traditional finance and introducing some really groundbreaking technology. So, knowing the basic mechanics and the very real risks involved, I want to leave you with this. How does this evolving financial system fit into your own long-term worldview? Keep exploring, stay incredibly curious, and thank you so much for joining me for this explainer.